It's time for Yahoo Finance's Market Minute. Stocks mixed as investors digest data showing milder inflation pressures, as well as President Trump renewing his threats to impose take-it-or-leave-it tariffs on trading partners. Boeing shares lower after an Air India Boeing 787 Dreamliner crashed shortly after takeoff on Thursday. Local officials confirmed that more than 200 people were killed. Air India is organizing relief flights for the next of kin of those on the flight. U.S. and British safety officials are traveling to India to support the investigation into the incident. And we're seeing shares of American and United Airlines also lower. Both fly the 787 Dreamliner from Boeing. The FAA ordered an inspection of the jet back in 2024 after a mid-air dive on a LATAM flight injured more than 50 passengers in March. That's your Yahoo Finance Market Minute. For more on what's trending, scan the QR code below to track the best and worst performing stocks in the session.
Welcome to Wealth. I'm Ali Cannell, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, a public debut. Financial tech firm Chime is IPOing today on the NASDAQ. At the end of the hour, we'll be talking to Chime CFO Matt Newcomb. You don't want to miss it. And portfolio checkup. One portfolio manager shares 5 stocks to consider buying right now. Plus, all week on Wealth, we're talking about student loan repayments. Today, we'll dive into refinancing your loan. What is a good interest rate? And when is the right time to refinance? Stay tuned. But first, we take a look at some of the market action 90 minutes into the trading day. Stocks are mixed right now as tariff concerns weigh on investor sentiment. You're seeing the Dow there leading the way lower. Joining me now is John Buckingham. He's a portfolio manager at Kovitz Principal Management. And John, uncertainty has certainly been the word of the day, the week, the month, but we've seen this resilience in stocks, this V-shaped recovery. How should investors be digesting this latest market action and really the volatility that we've seen?
Well, they should be embracing volatility. Volatility is the friend of the buyer of long-term value. And, we have had this massive rebound, 20% up. We really did have a bear market intraday, April 7, April 8th. We did get down more than 20% from the highs. And so hopefully investors have learned that stocks have proved rewarding over the long haul. They just have to have the patience and discipline to stick with them through thick and thin.
So there's been a lot of talk of diversification, investing overseas, looking out for opportunities. How do you identify those undervalued pockets of the market, and where are they within this current environment?
Sure. Well, it's a market of stocks and not simply a stock market. So while the major market averages are now in the black for the year, there are still many stocks that are down, believe it or not. And the average stock in the Russell 2000 index is down significantly. So, we are a value-oriented shop at the Prudent Speculator. We look to buy things that are on sale, try to take advantage of that downside volatility. Things tend to go to extremes. Investors get infatuated with certain stocks, and then they'll, of course, abandon other companies because sometimes there are short-term issues, or they're just not in a space that investors are attracted to today. So today, we like things in the energy sector because energy stocks have been hit pretty hard. A name that I think is attractive is Civitas Resources, probably one of the hardest hit. They're an oil and gas producer. A big dividend yield, low PE. They're still very profitable even at current energy price levels. And they've been very shareholder friendly in buying back stock and paying us a giant-sized dividend. Also, we've seen things like in the pharmaceutical area, a company like Merck, which we view as very high quality, trading at a PE around 11 today with a dividend yield of 4%. And, historically, Merck trades for a much higher valuation level. Happy to go through others if you'd like, or we can I'll wait for your cue.
No, yeah, because you have 5 stocks that you like. You hit 2 out of the 5. So what are some of the other names?
Sure. Well, again, lots of things have done very well this year. We own Oracle, which has had a great day today. So when I come on the airwaves, I like to talk about things that haven't had their day in the sun. So something like Whirlpool, which is the appliance maker, there your yield is over 7%. PE is in the 9-10 range. And again, we do think that interest rates will be coming down later in the year, and that will support housing, and that a stock like Whirlpool, this is the time you want to take advantage of it before all of that has happened. Another stock that has struggled mightily is Target, the big discount retailer. Here again, you have a very low valuation relative to where it historically trades and a dividend yield that's pushing 5%. And then a final stock would be UPS, which is the package shipping company. Again, the theme here is low valuations and generous dividend yield. And in a market where the S&P 500 is trading at 23 times forward earnings, our portfolios trade at 14 times forward earnings, and then our dividend yield on our overall portfolio is 2.5% versus 1.3% for the S&P 500. So I think you can be selective in this market. I do think that stock picking is going to be much better going forward than buying the indexes. And it certainly helps us sleep better at night with reasonable valuations and generous dividend yields on our stocks.
So, John, you mentioned interest rates, and I want to talk about the Federal Reserve and what they could do in the future. We saw inflation moderating. We have jobless claims likely ticking up from this morning. Do you think the Fed is now in a position to cut rates sooner than previously expected? And do you think we'll be cutting for good news rather than bad news?
Well, that seems to be the mindset, is that we actually could get good news rate cuts as we go throughout the year. Will the Fed cut, very soon? I don't think so. I think there's obviously certainly a lot of uncertainty about tariffs and their impact, and inflation expectations in some of the surveys that have been done are still very high. But obviously the CPI and the PPI this morning being, coming in lower than expected is a positive. Even though the jobs number for the month, that was out on Friday was good, jobless claims have ticked up. So I do think the Fed is going to be in a position at some point soon to cut interest rates. But more importantly for investors, you don't need the Fed to cut interest rates. Again, historically speaking, stocks have done fine, whether the Fed is tightening or easing, whether interest rates are rising or falling, whether inflation, believe it or not, is high or low. And even, believe it or not, in terms of if we go into a recession, the historical numbers we've looked at for the 15 prior recessions we've had have seen stocks, at least value stocks, lose a couple percent on average during the recession, but nobody can time the start and end of the recession. Heck, they don't even know when it starts and ends until after the fact. But most importantly, coming out of recession, returns have been spectacular in the 30 to 40% range. So you don't want to miss out on that upside by sitting on the sidelines, because you're worried about the next shoe to drop. And frankly, they don't ring a bell to mark a market bottom.
Interesting for investors. You don't need rate cuts. John from COVID's Principal, thank you so much. Now time for some of today's trending tickers. We're watching Oklo, Voyager Technologies, and Joby. First up, nuclear energy startup Oklo is seeking to raise $400 million in a secondary share offering with the option for an additional $60 million. The news comes as the firm announced a likely contract with the Department of Defense. Wedbush has raised its price target on shares, seeing about 10% upside for the stock. Next, Voyager Technologies is extending gains after its public debut, with shares surging more than 80% on its first day of trading. That follows a $383 million IPO. The Denver-based defense contractor serves both government and commercial clients in the space and national security sectors. Key partners include Palantir, NASA, Lockheed Martin, and the U.S. Air Force. Finally, shares at Joby are falling after a downgrade from Cantor Fitzgerald, the firm cutting its rating to neutral from overweight, saying that while they remain bullish on the electric air taxi industry over the medium to long term, they are more conservative on Joby in the near term due to the recent share price rally. Joby shares have surged 80% from their April lows. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Health and Human Services Secretary Robert Kennedy Jr. unveiled 8 new members of the government's top vaccine committee, including multiple names who have shared skepticism towards and in some cases misinformation surrounding COVID-19 vaccines. Here's what this means for Americans is Yahoo Finance senior reporter Jordan Weissman. So Jordan, let's start broad here. What is this committee and what does it do?
So this is what's known as the Advisory Committee on Immunization Practices. This is basically the most important panel of experts when it comes to U.S. vaccine policy. Their job is to advise the Centers on Disease Control on what shots you should just add to their routine vaccine schedules, what shots adults and children should just should get. This affects things like what vaccines school districts require for young kids, but also importantly for, I think, people's wallets, it determines what insurers have to cover. Under the Affordable Care Act, for instance, private insurers are required to cover free of charge vaccines that are recommended by this committee. So this, decision by Kennedy to fire everyone on the panel and then replace them with some noted vaccine skeptics could have both vast public health consequences, but also some financial consequences for viewers.
Right. Well, let's talk about those financial consequences. Could this result in Americans paying more out of pocket? And if so, how?
Yeah, absolutely. So as I was saying, this panel, when it recommends a vaccine, private insurance essentially has to cover it. So does Medicare Part D, so does Medicaid, so does CHIP. Essentially, when they say a kid should get this shot, should get a measles shot, should get a COVID shot, that becomes free to the parents, right? If they rescind any of those recommendations, which it looks like they could potentially do, it means suddenly insurers will have to decide, private insurers specifically will have to decide, are they going to continue covering the cost of those vaccines, or are they going to start charging copays? Are they just not going to cover them at all? So in the cases of some vaccines where they might charge, or they might cost $10 or so out of pocket, it's maybe not a huge deal. But there are some shots like, say, Gardasil, the HPV vaccine, that can cost upwards of $300 a shot. So it could actually, put a hit on some patients.
Great, Jordan. Important information to know. Thank you so much.
Thanks for having me.
Coming up, we're talking to the CFO of a financial tech company, Chime, which is making its public debut today on the NASDAQ. Don't miss our conversation with Matt Newcomb at 11:50 a.m. Eastern Time. Plus, summer travel trends. We break down how Americans are spending heading into the busy summer vacation season. Stay tuned. We're coming up on the official start to summer, and new data from Bank of America is signaling a potential slowdown in consumer activity. Seasonally adjusted credit and debit card spending per household declined by 0.7% in May from the prior month. The firm cites a few factors: declining gas spending, payback from tariff-driven stockpiling earlier in the year, and even poor weather in some regions. But the question remains, could this be a sign of weakening consumer sentiment? Joining me now on set is Mary Hines-Droz. She's the head of consumer products at Bank of America. So Mary, thank you so much for being in studio today. We're seeing this spending drop. How significant is that in the context of recent trends?
Yeah, it's the first time we've seen a contraction in seasonally adjusted spend in a long time. But when you decompose what's driving it, it's okay. We shouldn't get worried yet. Because really, gas prices going down, the transactions are still the same. It's just costing them less. We also saw during the tariff announcements in April, a lot of people accelerated their spend for certain things like electronics. So April, we saw 7.5% increase in electronic purchases. In May, it's down 1%. So that's because it's just a pull forward, not because the consumer is weakening. And we're in New York. Every weekend has rained.
Yes.
So we don't have the normal summer activity happening, which is also a driver why spend's a little weak.
And what categories has spend been the weakest in? Is it mostly that discretionary spending, or are we seeing a pullback in any essentials as well?
Well, it's more the discretionary because essentials are more expensive.
Right.
So overall this year, we've seen higher insurance, utilities, taxes. So therefore, you've got to say, well, what am I going to spend less on? So instead of restaurants doing more groceries, instead of high-end groceries, you go discount. So you're really making choices in order to manage some of those things that are just simply more expensive.
So how does this illustrate this more cautious tone that we've been hearing from the consumer? Obviously, a lot has happened since those tariff announcements were announced in April, and we've seen various sentiment survey data come out and be very pessimistic. But recently, that's been the opposite. There seems to be a little more optimism out there. What are you guys seeing?
Yeah, we definitely saw a bounce back in consumer sentiment in May from April. Which is expected, right? There's been some trade deals. There's been less of a certainty that things are going to get more expensive. And so consumers are feeling pretty good. but life has gotten more expensive. So they're still traveling. They're just doing it in a more affordable way.
So adjusting to a more new normal of sorts.
Exactly.
And we were just talking about in the break about how you guys have seen a lot of retail trading activity. Tell me about that when it comes to buying the dip and new investors.
Yeah,
getting into
well,
this
what's
market.
interesting is we're seeing younger generations be much more interested in retail investing. And we have a Merrill Edge, a self-directed platform, which enables people to really take advantage of some of those opportunities, which it's kind of just an interesting phenomenon with the comfort level.
Yeah, very interesting market right now. You mentioned the summer season, spending trends there. What are you seeing in terms of the dispersion between higher income consumer, lower income consumer? Where are people spending, if they are at all?
Yeah, well, higher income consumers really fuel the economy because they spend the most. But they're just making more choices and they have more flexibility than younger ones. When you look at the younger consumers, they're having to face childcare costs. They don't necessarily own their home. Rents have become more expensive. And so they're more impacted by some of the dynamics that's going on in the marketplace.
And talk to me about destination dupes. What is that? Why are we seeing that being a shift?
Yeah,
here?
this is really interesting. Bank of America did a summer travel survey, and 92% of those we surveyed said they were interested in destination dupes. And this is where you have a place that you'd like to go. I'll use an example that I did personally, Santorini in Greece. Santorini is really, really popular, so it's super crowded, super expensive, and a lot of people have been there. A dupe for that is to go to Paros. It's less well-known, much less expensive. I was able to get a much better hotel than I could in Santorini at a fraction of the cost. And I've done something unique, so I can post it on social media.
Yeah,
so
we love that.
And you've seen a lot of the media around places like Venice and Barcelona, where even the locals are so tired of all the tourists. It's not creating a great experience. So this is just another way to have a really memorable vacation, lower cost, and more unique.
I was just in Greece. I have to go back now with this dupe
Totally.
location. Amazing. So we're also seeing the entertainment economy continue to chug along here. We know live events, sports, that's been driving a lot of the economy. So B of A had cardholders spending $1.5 billion over the last year on entertainment. Where exactly are they putting those dollars?
You know, it's interesting in that when we did their summer travel survey, we found that 50% of the people that we surveyed had traveled for a live event in the last 2 years. And in 2025, a third of them said they want to spend even more doing that. And that just goes back to the post-COVID desire for experiences. And people just love being there in the moment, and it creates such a memory. And that's where a lot of the discretionary spend is going. And it is expensive. Concerts, amusement parks, a lot of live things are just really pricey.
Yeah, I just saw Beyonce, so I'm well aware of the expense there. But you're right, totally worth it and a really fun experience and a good memory. Mary, thank you so much for your insights. Appreciate it.
Great, thanks for having me.
Coming up, as we were just discussing, summer is around the corner. What could the new season bring for the housing market? We hear from an expert next on Wealth. Let's get a quick check of the markets. Obviously, this week, investors digesting a lot of economic data. We have slowing inflation on the consumer side yesterday. This morning, we saw a slight uptick in jobless claims. You're seeing across the board here a mixed picture. The Dow is leading the way lower, down, let's say, 0.2% here, being dragged down by Boeing after that plane crash in India. Boeing shares are off about 5%. You're seeing the Nasdaq trade just above the flat line, hovering near those record highs. Same story there with the S&P 500 up about 0.1%, also hovering at those records. Now, besides the economic data, we're also continuing to hear more about the tariff picture there from President Trump. He's saying that trading partners, they could either take or leave trade deals. That's worrying some investors that we could see an escalation in this trade war. So more to come there. I also want to take a quick check on Treasury yields. The 10-year yield continues to edge a little bit lower. We saw solid demand at a recent auction, along with that softer than expected inflation print. The 30-year yield, we do have a 30 30-year auction later this afternoon, so that'll give us a good sense on where demand lies for longer term yields. And then the US dollar index, if we take a look over the past 10 years, we are just steadily on the decline. We actually hit some of our lowest levels since March 2022. So something to keep an eye on as we continue to track US exceptionalism. But for now, we're trading below the critical 100 level. Well, moving on to housing, all 50 of the largest U.S. metros posted annual inventory gains in May, though less than half are back to pre-pandemic numbers. That's according to the latest data from Realtor.com. Here to explain what all of this means for the summer home buying season is Danielle Hale. She's Realtor.com chief economist. So Danielle, inventory is on the up and up. How significant, though, is that for today's buyers?
Well, it's certainly a step in the right direction, though the context is we have seen inventory, drop during the pandemic and remain low for a long time. So even after this recovery, which is pretty significant, up more than 30% year over year, we're still nationwide down about 14% compared to pre-pandemic levels. So we're moving in the right direction. We've still got some ways to go on a nationwide level. It is worth pointing out, though, that we're seeing some variation in recovery across the country, and some regions are much better recovered, in some cases back to above pre-pandemic normal, whereas others are still lagging behind. So there's a national trend, and then it really depends on where you are.
So what are those regions, Danielle, that are experiencing this bounce back, and what are the ones that are struggling?
Yeah, so in the South and in the West, we've seen much more inventory recovery. Construction is a big reason for that. So as builders have been better able to add new homes to the market in the South and in the West, we see more markets that are back above their pre-pandemic levels of inventory. By contrast, in the South, in the Northeast and the Midwest, we see that inventory still lag by about 40 to 50% below pre-pandemic norms. So we're still pretty tight in the Northeast and the Midwest, which means relatively competitive markets for home buyers, but a little bit more buyer negotiating power in the South and the West, where construction has really helped inventory recover.
Danielle, we did see the spring market be a bit sluggish. What will it take to have that rebound in the summer? Is it all tied to mortgage rates?
I think it's not just mortgage rates, but they're an important part of the story. And the story is really about housing affordability. So housing affordability is about the cost of financing a mortgage, which is mortgage rates and home prices. And then also about buyers' ability to pay for that mortgage, which is an income story. So incomes have looked pretty good as the labor market has been relatively stable. Home prices have remained relatively high in many parts of the country because of that shortage of inventory in some parts of the country. But it's worth pointing out we're seeing some softening in prices in regions where construction is better recovered in the South and in the West. And so that's going to help a little bit. And then, of course, mortgage rates, when mortgage rates come down, that not only helps buyers' dollars stretch further in a mortgage, it also means that more sellers are at a point where it becomes feasible for them to get unlocked from their current low mortgage rate. So mortgage rates help on both the demand and the supply side of the equation, and would certainly be welcome in the housing market. It would lead to higher transaction activity if we saw mortgage rates come down.
So how can buyers secure the best possible rate possible for their mortgages?
Yeah, that's right, because buyers don't control the overall market trends, but there are things that buyers can do regardless of what happens to the overall market. And those are things like boosting their credit score so that they're a better qualified borrower. They can take on additional jobs to boost their income, which will help improve their debt to income ratio, or they can pay down debt to improve that debt to income ratio. They can make a larger down payment or look for a less expensive home that will help boost their loan to value ratio and lead to a better mortgage rate. But I think the most important thing that buyers can do, which is also the most within their control, is to shop around among lenders. That nets them the potentially biggest savings in a mortgage rate, and it's something that anyone can do regardless of their situation.
Now, we're in an environment right now where the Federal Reserve could ease monetary policy, so lower interest rates. Is there some sort of way that buyers could time this market in order to secure the best rate?
I wouldn't advocate for timing the market, because I think it's worth pointing out that in September, the Fed started lowering its short-term policy rate. And then we actually saw mortgage rates move higher. In fact, their low was in September, right before the Fed started cutting rates. So it's not really about what the Fed does now. It's about the anticipation of what the Fed's going to do and how that affects the long end of the yield curve. That matters much more for mortgage rates. I think in an earlier segment, you were talking about some softness in the 10-year Treasury. That is actually actually the rate that is tied most directly to mortgage rates. Mortgage rates tend to track the 10-year yield more than they do the Fed's policy rate. And so paying attention to what's happening in the 10-year yield will give buyers a good indication of what they can anticipate for mortgage rates.
What about the rental market right now? I think New York City rents just hit another record as we're seeing buyers wait on the sidelines a little bit more than usual. Are we seeing the rent side of the equation just skyrocket more recently?
Nationwide, rents have actually been flat to declining, so relatively soft over the past couple of years. But we haven't seen huge declines in rent. So over the past couple of years, we're down just 5% or so from the peak rental market. It also depends on where you are, though. So you mentioned New York City, the Northeast, cities like New York and Boston tend to see rents continuing to move higher. On the flip side, parts of the South and the West have seen a bit softer rental pricing trends. So it really depends on where you are, what kind of rent trends you're seeing.
Danielle Hale, thank you so much for those insights on this tricky housing market.
Thanks for having me.
Coming up, we help you make a plan for your summertime expenses. Plus, have you ever considered refinancing your student loans? We get insight from an expert about when is the best time to consider a new loan. All that's next on Wealth. According to KPMG's Summer Consumer Spending Polls, Americans are planning to cut back this season, spending less on travel, dining out, entertainment, and even personal care and apparel. Joining us with some more summer budgeting tips is Rodney Williams. He's a co-founder and president of Solo. So Rodney, summer can be expensive. What are some of the categories or things that people tend to overlook this time of year?
Well, they definitely overlook the personal expenses to see Beyonce.
Yeah, which I did a little bit.
We all did a little bit.
I try to be good.
But it's tough, right?
Yes.
The best thing about summer spending, but it is spending on family. It is spending on the things you really want to do, and maybe going to the beach. And but all of these things can add up and cause big problems if you're not budgeting correctly and you're not looking for savings wherever you can.
And what about air conditioning too? I mean, that always hits me. I never realize how much I'm actually using until it's too late and I have to pay the bill.
That's why I think spending is going to decrease this summer, because at the end of the day, our cost of living is increasing during the summer. That means AC. That means travel cost does actually increase, meaning sometimes gas is more expensive. And some of these things you aren't necessarily budgeting or planning for. So when they happen and they wipe out your savings or they wipe out something that you wanted to do as a luxury, it can cause a problem. And
your report found that unplanned expenses cost the average American family about $2,000 a year. What's one smart move that people could make to try and avoid that trap?
Your emergency fund. Now, I know everyone doesn't hear to save, and especially during the summer when you want to go out and have fun with your friends and family, but saving is important, and that emergency fund is needed. That flat tire can derail you from work. That car breaking down, or even just a sick pet going to the vet could cause an issue.
How about credit cards? Because I always try and utilize my credit card points to the best of my ability. Are there tips and tricks that you can use to make sure you're getting the most out of your cards?
Yeah, it's a double-edged sword, right? Great points, great travel perks, but you should not keep a balance. So if you're going to spend on your credit card, try to pay it off as soon as possible. You don't want that fun vacation to haunt you during the winter as you come up to Christmas, and that's the strategy.
What about the new grads that are now entering the real world? What are some tips that you would give them that they should start today as official adults now?
Well, don't do what I did, which is throw away the student loan paper, right? Open up.
Not done yet.
Not done yet, right? You should know your bills for the future. I will say if you don't have a job, you can defer your student loan payments. And a lot of students don't know that. So if you do not have a job, defer your payments, but know what you are going to pay once you get a job. I would say try to get a job. It's super important, even if it's not the ideal job. A summer job could be really fun, could be really allow you to have some savings and allow you to have some freedom.
We are in a tight labor market, though, and some students might have a tough time finding jobs after they graduate. What about the gig economy? What are some different things that people could do to try and offset any losses that they could see if they don't find that job?
Yeah, I call it underemployment. right?
Underemployment.
Right, because you have a job, but it's not the ideal job. It's not the job you want, right? You went to school for being a graphic designer. You haven't gotten that graphic design job, so maybe you turn to DoorDash or Uber to make ends meet. But the flexibility and the freedom around those jobs are unmatched. Right? You can work when you want to, you can do limited hours, you can plan it accordingly, and there's so many options in the gig economy world, right? From TaskRabbit to DoorDash to Uber Eats, you can just be a courier. You can put up TVs for TaskRabbit. So try to cater to something that you actually want to do and that you're actually good at.
What's the number one mistake that you see new grads make when they graduate?
The number one mistake that I see, they don't necessarily understand their options when they get into debt. Right? And sometimes they just freak out and don't pay. And all of a sudden, 2 years later, when they get that dream job, right, at Yahoo, and they're excited, all of a sudden they have to come out of a debt trap and they have to come out of a hole that is really deep. So as a summer graduate, please look at your debt, manage your expenses, understand what you're going to have to pay once you get that dream job.
All right, you heard it here first. Rodney, thank you so much. Appreciate it.
Thank you.
All week, we're giving you everything you need to know about paying back your student loans. Today is all about interest rates and refinancing. An interest rate is basically the fee a lender charges for borrowing money. It is usually expressed as a percentage of the total principal amount owed. When refinancing, a borrower will swap their original loan for a new one, usually at a lower interest rate. Joining us now to discuss is Andrew Pentis. He's Bankrate consumer lending analyst and a certified student loan counselor. So Andrew, if you're just starting this process, what's the easiest way for borrowers to first check their current student loan interest rate so that they know the baseline of where they're starting?
Yeah, it really depends on what your type of loan is. So if you have a federal student loan, the best way to check your current student loan interest rate is to log into your account at studentaid.gov. You can also talk to your federal student loan servicer, though that's easier said than done with long wait times and a diminished Department of Education. But in terms of your private student loans, yeah, check your statements if you receive a paper bill in the mail, or contact your lender directly or log into their online portal if you can. But it should be fairly easy to collect those rates.
So what would you consider a quote unquote good rate for a student loan right now? And what should borrowers aim for if they're shopping around or thinking about refinancing?
Yeah, good rate is lower than the rate you currently have and the lowest possible rate that you can qualify for. That's the short answer. But for context, federal student loan interest rates have been in the single digits for a long time. It was recently announced that rates for next school year will actually descend a bit. We're in a higher rate environment for those private student loan rates and refinancing rates, but still there are single digit rates out there. So if you do have good credit or a creditworthy cosigner and you can lower your interest rate through refinancing, it can be really wise.
When does it actually make sense to refinance, and when should borrowers avoid it, especially if they do have some of those federal loans?
The slam dunk situation for refinancing your student loans is if you already have a private student loan with a high interest rate. And that's because if you refinance it to a lower rate, you're not giving anything up. You might even switch to a better lender. But the more complicated situation is if you have federal student loans and you're considering refinancing those or lumping those into a refinance application with your private loans. And the reason it's complicated is that federal loans contain a lot of safety nets and protections, like access to income-driven repayment plans that cap your dues at a percentage of your monthly income, as well as pathways to loan forgiveness. So refinancing those loans would strip those benefits away and turn the federal loans into a private loan permanently. So you really want to tread cautiously about refinancing those government exclusive loans.
You mentioned better lenders. So if someone does decide to refinance, what types of lenders should they be considering?
All types. There are credit unions, banks, online lenders, and marketplaces like Bankrate, as well as state guaranteed and state funded agencies that offer student loan refinancing. So just like with any other consumer financial product, it really helps to survey the landscape, check in with different types of lenders, and that way you hopefully get various offers that you can compare and get the best deal possible for your situation.
And given the current economic uncertainty, what are some guidelines that borrowers should keep in mind before refinancing or locking in that new rate?
Yeah, the thing to harp on here really is that if you have that federal student loan and you're considering refinancing it, as you mentioned, given these uncertain economic times, you really should be hesitant to refinance those federal student loans, at least until the dust settles. And the reason for that, again, is that If you keep your federal student loan and something happens, maybe you lose your employment or lose some of your income, you have access to some relief through that federal student loan. So whether it be a deferment or forbearance that pauses your monthly dues, or that income-driven repayment plan that caps your monthly payment, those are really important protections to have when you might not be sure, for example, that you're holding on to your job. So definitely that's the best advice for now.
And we've been talking a lot about the Federal Reserve, how they could potentially lower interest rates sooner than expected. If you're considering refinancing now, can you refinance multiple times, or should you wait and try and slow play it?
Absolutely. This is not a situation where you have to feel like you need to time the market, because if you can get a lower interest rate right now, say by refinancing a private student loan, it could save you lots of money in interest. And then yes, say that rates descend in 2026 or later and you want to refinance again, you can absolutely do that, assuming that your credit has maintained and you've built up a positive payment history on your existing refinance loan.
Andrew, some smart tips for those borrowers. Thank you so much. Appreciate it.
Thanks for having me.
Coming up, we're talking to the CFO of financial tech company Chime, which is making its public debut today on the NASDAQ. Don't miss our conversation with Matt Newcomb. That's next. President Trump is set to sign 3 congressional resolutions taking aim at California's push to phase out gas-powered cars and expand EV adoption. California's law requires that all new passenger vehicles sold in the state be zero emission by 2035, with interim targets starting at 35% by 2026. The policy, led by Governor Gavin Newsom, has been adopted by 11 other states, making this a potential shift with national implications. The move would roll back EPA waivers granted under the Biden administration, which gave California the authority to set its own vehicle emission standards. Newsom is vowing to fight the repeals in court, calling the congressional act illegal. Automakers like GM and Toyota are expected to benefit from the rollback. The companies heavily lobbied against California's EV mandates. Financial tech company Chime is making its public debut today on the NASDAQ, priced at $27 a share. The IPO values the company at $11.6 billion, a sharp drop from its last private valuation of $25 billion just a few years ago. This debut will be a key test for investor appetite of consumer-facing fintech names within an otherwise sluggish IPO market. Chime offers fee-free banking via mobile app, including checking and savings accounts, debit and credit builder cards, and high-yield savings, all without monthly fees, overdraft fees, or minimum balance requirements. Joining us now to talk through the company's journey to the public markets is Chime CFO Matt Newcomb. So Matt, congrats on the IPO. You guys are not trading just yet, but let's first start why now was the right time for you guys to go public.
Yeah, thank you for having me, Ali. It's great to be here. This is obviously an amazing day for Chime. It's amazing for our nearly 1,500 Chimers, but more importantly, this is an amazing day for our members. And we think this really marks what we believe to be a generational shift in the way that everyday members are being banked in this country.
You priced above range at $27 a share, but you're still valued below what you were a few years ago. Why do you think that was? What do you account for that shift?
Yes, my philosophy on this is you can control what you can control. Markets come and markets go. What we can control is being focused on our mission and building our business. That's what we've been focused on since day one of this company. That's what we're going to be focused on here going forward as well. And we believe we've got a generational opportunity to build a new business that banks everyday Americans in an aligned way that's actually helping them make progress in their financial lives.
Well, let's talk about some of that opportunity. You guys are not profitable at this point. What's the path to profitability? How long do you think it will take to get there?
Yeah, we've, I think, got a very unique business model at Chime. Even though we're in the business of offering bank accounts, our business model is not very bank-like. Instead, you should think about Chime as really a payments-driven company. And because of our members' deep engagement with Chime and the way that they habitually use us to pay for their everyday expenses, this is a recurring payments business. We've been investing in exciting growth opportunities for the company. We've made tremendous progress on our profitability over the last couple of years. And it's really the strong unit economics in our business that drives our performance.
Like you were saying, your model relies on interchange fees rather than those traditional banking fees. How sustainable is that, though, as you scale and now face pressure from investors now that you're a publicly traded company?
We love this model. We love this model because it is, again, aligned with our members. We only win as long as we are earning the trust of our members to serve as their primary account. More specifically, when our members are using us as their top of wallet card to pay for their everyday spend. And the reason that's aligned is when you compare that to the way that the incumbent banking system serves everyday consumers, this is not coming on the backs of our members. Our products are largely free, and it's helping them get ahead in many areas of their financial lives.
And the average Chime customer is 36 years old. What are you seeing there from that demographic when it comes to spending, saving, and adoption of digital banking?
Our members look a lot like America. They represent where Americans work, the biggest industries that employ Americans, like healthcare, retail, restaurants. It's really the heart and soul of what makes up this great country. And they've trusted Chime to be their primary banking relationship to help them across many areas of their financial lives, whether that's spending, saving, borrowing, and perhaps other areas in the future as well.
And your first day on the markets, can you just talk to me about the journey that it's taken to get here and what it means to you as a CFO?
Look, this has been certainly a journey, starting from some of the earlier days when we were just a small company looking to, but with a big mission, looking to make progress. It's incredible to see the progress that we've made at this company. At the same time, we feel like this is just day one. We are serving 8.5 million Americans in a market of roughly 200 million Americans. And so there's lots more ahead for Chime for sure.
Mm-hmm. Lots more ahead. And it's also an interesting environment right now with interest rates high, a lot of uncertainty. How are you preparing for potential changes in consumer spending behavior?
I think what's really unique about our business is, again, because our members use Chime to pay for their everyday expenses, our payments business is very concentrated in non-discretionary spend. And that tends to be resilient regardless of the macro cycle. And I think there's been a lot of headlines about worries about the economy and macro. What we see is a resilient consumer spending and a lot of behavior on our platform, very much in line with what we would expect.
A resilient consumer, that's a great way to end it. Matt, thank you so much, and congrats again on the IPO.
Thank you for having me.
Let's do a final check of the markets here. Again, we are still trading mixed. So the S&P 500 is up about 0.2%, NASDAQ up about 0.1%. And then you have the Dow down marginally, just 36 points there, being dragged down by shares of Boeing. Of course, we're going to continue to watch the developments on the tariff front as President Trump says that these trade partners can, quote, take it or leave it. But for now, that is it for Wealth. I'm Allie Canal. Thank you so much for watching. Stay tuned for Market Domination. That's coming up at 3 p.m. Eastern with Julie Hyman and Josh Lipton.